The S&P 500 is at a major crossroad right now here at 580. And in this video, I'm going to share the 3 reasons why it's at a major crossroad, and I believe it to be on the edge of a cliff. And then I'm also going to provide my trade setup for this week, how I plan to trade it. So without further ado, here we go. 580 is super critical. The reason we know it's critical is because, well, we've already retested this level multiple times. You can see over here, this low formed before we went all the way up to 600 again. Then the second low formed over here, so double bottom. And so far, this is a triple bottom. If you know anything about triple bottoms, typically they are bearish and you do see a breakthrough. Not always the case, especially with S&P 500. It's been known to find demand around a specific level quite a bit, but typically you want to see the first bounce end up having continuation higher, or the second bounce, call it a double bottom. You want to see continuation from there. Since we have not yet seen continuation from here, we have to be very cautious for a break below 580, because if that does happen, there are no significant supports until the high 560s, which means it likely would be a flush scenario into the high 560s, probably 568 as the target. So it is critical that bulls are able to defend this level, this 580 and 92 level that I have here, this pivot on Monday of this week and going forward from there. If they can defend it, then there is a potential setup, which is the first setup I'm going to share based on adding calls with a target of 590.50. This 590.50 pivot is one that I've had now for over a week. It's actually worked really nicely. You can see just based on how price has traded around it, we found either supports off this level, resistance, initial resistance over here, support after retested, another resistance, et cetera, et cetera. So it's worked really nicely. And if bulls are able to hold it above this 580.92 level, my personal target would be this 590.50 before it decides if it wants to either, and I'll show you here, either reject and go down and then retest again, or if it actually wants to break out. Either we see a clean break just higher, or maybe it wants to curl down first and then break higher. Those are potential paths. And based on these paths, that's how I can take that trade setup. So that example setup here would be, let's say we have a gap up on Monday or a strong initial hourly candle. And I'll get rid of this here just to make it a bit easier to look at. But let's say we have a gap up or that hourly candle and it closes right around 584. Well, if it closes around 584, that means there's another strong response to this 580 level, kind of like what we had over here, and then this would be the third time we had a strong response. Personally, I'd like to see it close above this high because this is a bearish engulfing candle in the 15-minute. So whenever you are able to reclaim a previous high of a bearish engulfing candle, that is a good sign, since bearish engulfing candles typically form off of critical resistances. So this top over here, this 584.40 level is a critical resistance. So if we saw a gap up, probably not, seems unlikely that we'd have a gap above that level. But if we had a gap up and go and first hourly close up here, or maybe even opens flat and somehow an hourly candle closes above that level, that's what I'm looking for. If that is to be the case, I can take a long setup somewhere around this range over here with that hourly close above. And my risk in this case would be a breakdown back under my 580.92 level. So in this case here, be looking for an hourly close under 580.92. That's about a 4, maybe even 5-point risk, which I realize is a little bit more than what I typically would take, especially for something where the target seems to be 590.50. However, there's a nuance to this setup. And that's because if I were to add off of here for 4 or 5 points of risk, my initial target would be 590.50. However, if we break above 590.50, we will see 602.70 soon after. That is the low of the previous distribution zone that we had from up here. You can see we actually retested it over in this period when I was long, and then we had that rejection over here. So I was unable to reclaim this 602.70 level. If we can break back above 590.50, then that would be the following target. And of course, 4 to 5 points of risk for potential of 15 plus points of reward would be no problem in my book. So this is the entire setup really, and 590.50 is just one part of the overall picture. That's why I'd be comfortable taking this. Now, if it's unable to get back above 584 with that hourly close, then we're starting to look a little bit more cautious around here, because there is that possibility we have that breakdown below 580. And of course, like I said, there's a major gap over here from this period. This is the election gap. So far, it has remained unfilled, which is bullish. If a breakaway gap remains unfilled, that typically is a bullish sign. This is a breakaway gap just because it is a very significant gap up. up. So far it's held, like I just said. However, if we were to break down and then fill this gap, it's likely we would go into the 560s next before there's a viable dip. Probably going to be somewhere around this level. However, I prefer to wait until that happens to give you guys where I'd personally buy that dip. But somewhere around this 568-ish level seems to be where there is a lot of support, not only because of this over here, but then also the previous supported level we saw over here. And then this would basically be an extension dip buy off of somewhere around here. That is the alternate scenario. We have to see if that happens first, of course. But there are two possibilities for this week. I'm ready to trade either of them. That's what the weekend's for, is planning for these setups, because personally, I don't know which way it's going to decide to go. We've seen it chop in this relatively tight range for a couple weeks now, because it's already the second week of January, and we've been stuck here since almost the middle of December 19th. So it's been a long time we've been stuck in this range. So when it decides to break, we will have an extension move, and that's the extension that I want to trade. I do not like trading chop. That's why I don't like trading any of this price action. But what I do like trading is trend moves, extension moves, etc. And I believe that we are on the cusp of that, either to the downside or a potential for an upside extension move. First 590.50, 602.70. If we got above 602.70, then you're really talking new all-time high afterwards. So those are the technicals that I'm looking at. Also, another very important technical concept before I go over to the flow is SMH. And I typically don't reference this, and that's because we've seen a lot of consolidation lately, but SMH is the semiconductor ETF. And something very interesting happened here on the daily. You can see the high point that I have over here, and then the secondary point over here. This forms a downward trend line, so downtrend. And with these downtrends, typically you see a trend move once they break to the upside. In this case here, we actually had a major gap up over at this time period on January 6th, and then a major rejection off of that. And it was not able to hold the retest of the trend line. This is critical because the market has been propped up by semiconductors. Of course, the Mag 7 are the main, but NVIDIA is a component of the Mag 7, and semiconductors have been very bullish all of 2024. So that definitely helped tech, S&P 500, etc. To push as high as it did. And in this case here, this is a bearish sign. I'll circle this for you. This 4 candle sequence on the daily is very bearish, because typically when you have a breakout of a major downtrend, which this is, you want to see it either continue from there, or you want to see it retest that downtrend and then experience continuation after. And so far, that has not been the case. We actually closed the weekly back under this trend line that is bearish. So far, this is a failed breakout. Failed breakouts are typically a precursor to a lot more downside. There is potential they can save it, but really, I would not give it anywhere past Tuesday of this week and I just accidentally drew this line, but if they're unable to get it back above this trend line here, roughly around 251 by Tuesday of this week, I'd say it's a failed cause, and you really have to be careful, because obviously if semiconductors are bearish, S&P 500, especially QQQ, going to have a difficult time. And of course, we're teetering on the edge of this cliff right now for potential of a 560 high price target. So if semiconductors can't reclaim this, then there's a higher likelihood we do see that bearish scenario here into the 560s. And personally, I'm not interested in even shorting this right here, just because the market's been bid for so long. I prefer to just wait for the 560s and I'll long that dip instead. So a lot to look at this week in terms of the technicals. As for order flow over here, we had a couple interesting orders. I'll go to the start of Friday because that's where we saw a lot of activity. First of all, we saw a 535 put to start off the day. This is the March expiration, 2.2 million. This one's definitely something that caught my eye just because it is far out the money, of course, but it is a singular order. You guys know, if you're subscribed to the channel, I've been watching for a while, that I don't like to just base a bias off a singular order. I want to see continuous orders throughout the day, throughout the week, etc., that point in a specific direction. Otherwise, for all we know, this could just be a hedge. So this is interesting, but I want to see more. So I'll scroll up from here and we can start to see some other prints that came in throughout the day. Really, all of this here is meaningless to me. I don't really see much activity, all things considered. There's a couple put sell orders over here, these out the money puts that are a bit interesting. And I'll show you a bit later here. We also had some heavy put sell orders like this with a shorter dated expiration, which is preferable to see. And this one had 1.5 million in premium, and a little bit below that was 500,000. So over 2 million in premium of puts sold to open. These were far out the money as well. So they saw, in this case here, the whale saw that the VIX was pretty high. So of course that means the premium of those puts is going to be heightened since we're around 20, which is pretty high for the VIX, all things considered, if you compare it to 2024, where we were stuck like around 14, 15, etc. So this is definitely higher than normal. But then also this is interesting because this happened to be near the low of day before we had a nice bounce. So I'll go back over here to show you, but the spot price where they sold these puts was 581.59, 581.60. So over here, you can see 581.59 was right about during this time over here. And you can see that it did experience some type of bounce after, and then it closed about flat with where they sold those puts. So they'd like to see that this either stays stagnant and consolidates around here, or they'd like to see a bounce. That's likely what they're looking for, is some type of a bounce back into the range. They don't believe that this range will break just yet and satisfy this 560 price target that I have on a range break. So that's good to see, at least for the bulls. You do want to see put orders like this that are being sold to open, because these were sold to open. You can see the volume of the order is over the existing open interest, which is great for those bulls in this case. So that's a huge print. This is definitely eye-opening. We saw 2 in a row here. Also, we saw the previous ones from a little bit earlier on in the session. These 550 put sells, a little bit more time on them, but still 1.1 million in premium nonetheless. So good thing that they are selling these puts into heightened volatility. They believe that this will abate, and then as a result, likely we'll see upside in the S&P 500. So that's probably the biggest takeaway that I took out of Friday's flow. We did see some puts later on that were bought like this, 1.3 million for the March expiration. And then we saw a call over here, but this was a day trade because it does expire on Monday. And then really nothing much, all things considered, for the rest of the day. So nothing too insane based on the flow, but the major takeaway were these put sell orders that we did see, the 520 strike and the 550 strike a little bit lower. That at least shows that they don't expect this thing to drop just yet. Of course, we'll have to see where it opens on Monday, but that is good, at least if you're a bull, because they don't expect this range to break. So I'm going to be on the lookout for more of those orders come Monday and Tuesday, because that'll give a good sense if this thing actually wants to bounce to my 590.50 pivot up here. And if we don't see much more of that flow, then really I don't see a complementing bias based on the flow. And a trade, if I were to take one, would be solely technical related. And of course, that means I need to have good risk reward, as we always should, but even more so in this case because there's nothing else backing it other than technicals. And then the major thing and final thing I want to share with you guys in this video today is on the daily chart, and that is that orange trend line right here. Right now, we are under a major uptrend. This is an uptrend that held for about half of 2024. You can see from back here in August, there are 2 variations to it. My preferable one starts from this low over here, as you can see, and you can optimize it a bit more to see it fit that low of day. But there are 2 variations. The reason I say that is because there is the actual low trend line and the next higher low that forms. So of course this will be a trend line, but we're not even close to that right now. We actually broke below that all the way back in October, retested it, and then rejected. So this is not of interest to me. The one that is of interest to me is this one though, just because this is the one that's been respected as of recent and is around where price is, or at least was last week, where we had this upside move into the 590s. So, so far we did break below it with this hard breakdown from not only this distribution zone up here in December, but then also broke down below the trend line. We were able to retest it on the weekly over here, and then it broke down to close the weekly still under. So if we go to the weekly chart, you can see despite the daily closing back above, the weekly was unable to close above. You can see the wick right here and then collapsed under, and we have not seen a weekly close above since we were trading all the way back around early December. So that is very critical so far. And as long as we stay under, you do have to be careful of extension moves lower, especially below certain ranges like the one that I shared in this video today between both of these green levels, because we're near the low of the range. There is flush risk when you are near a low of a range. So do be careful of that. And do be careful as long as we remain under this trend line here. Regardless, looks like there is potential setup for this week though. We'll just see where it opens, see if there's any strength over that bearish engulfing on the 15-minute over here around 584. If that's the case, I'm looking at longs for my 590.50 for a trim, and then higher if it's able to reclaim that. Otherwise, if it stays down here and even decides to break below the low that we saw last week, then that's something that I want to stay out of, and I'll reevaluate it in the high 560s. Other than that, as always, appreciate you guys watching this video. See you next time.